to the Virtual Center for the Study of the Constitution and Civic Responsibility, an ongoing inquiry into American political origins and evolving institutions. The Executive Director of the Virtual Center is Dr. Bill O'Brien. He's also your host for this continuing conversation. Here he is now, Dr. Bill O'Brien.
Bob Kincaid, thank you so very much, and welcome to the Virtual Center for the Study of the Constitution and Civic Responsibility. It is a Monday. It is the first day of June in the year 2015, and it is a pleasure to be with you here at the Virtual Center. Let me begin with yet another apology. This is two apologies, 2 consecutive weeks, and I believe Bob Kincaid and I got our wires crossed last week. I had announced, if you remember, at the end of our last program last Wednesday, that we would not be doing a program today, Monday, or tomorrow, Tuesday, because Bob had to leave town, but that we would be doing a program Wednesday. Well, in interacting with Bob over the weekend, I realized that I have misspoken. And Bob's going to be out of town tomorrow and Wednesday, and we were in line to do a program today. So I'm guessing that there may not be as many folks out there listening live as there usually are, because I had announced that we would not be doing a program today. However, for those of you who are out there, I appreciate your tuning into the Virtual Center. I appreciate your patience in putting up with some of my faux pas, but more important, I want you to know that we will not be doing a program tomorrow or Wednesday. So after today, our next live program will be a week from today, and that will be Monday, and I believe that is the 7th probably the 7th of June, or maybe the 8th. I can't remember. But anyway, all I can say is the pressure's on, because this is our last program for a week, and obviously I'm going to do the best I can to make it one that will stick with you and stick with me over the course of the next week. I'm in the process of doing some serious thinking myself over the next couple of days, since we don't have a program, live program on. Actually, I'm planning to use this week, or a good portion of it, to revisit this idea that I had talked about several weeks ago here, the Virtual Center, about doing a book on civic responsibility, and I think I'm going to revisit one that I had begun about a year ago, and I kind of left it. I had done I think a fairly lengthy 40-some-odd pages of narrative. And I'm going to revisit that with this new idea in mind. But that's where I plan to go. In the process, I'm going to be laying out or scoping out a direction that I think our programs here at the Virtual Center ought to go. I recognize that we have not done nearly the justice that the work itself warrants to Gary Wills's book, Explaining America, the Federalist Papers. If you remember, it's been months, literally, since we last visited that wonderful, wonderful text. And I want to get back into it again in order to get back into the 18th century a little bit. But as you know, over the last couple of weeks, we've been enmeshed in the issues surrounding what Richard Sennett called the New Capitalism. In our last program, last Wednesday, I spent quite a bit of time addressing what I believe is a revised opportunity, an opportunity for renewal, if you will, for organized labor. I've received and continue to receive a number of comments, many of them, most of them positive, but some of them cautioning me that this is a little bit more idealistic and optimistic than I probably ought to be if I expect any positive outcomes from this. I think a lot of that is my responsibility and my ability to follow up and handle handle some of this stuff. But I really believe that it's extremely important. And where I had hoped to go, and this I would envision to be, for at least for a while, the culmination or the final program, if you will, on this particular topic. I had mentioned a couple of times over the last couple of weeks that I would like to get into the Work Keys program a little bit. And you remember we talked about this about a week ago. And I'd like to spend a little bit of time getting into it today. That was, if you remember, my previous apology, because I had taken on the Work Keys program toward the end of one of our programs. I believe it was on a Tuesday a week ago. And I had created inadvertently the impression that I was advocating or supporting the idea of Work Keys in order to address some of the problems identified by Richard Sennett. Well, of course, the fact of the matter is, at least on its surface, the Work Keys program does not at all address the concerns that Richard Sennett brings to our understanding of the new capitalism. In fact, the Work Keys program seems to be a product of what I've called, for lack of a better term, the old capitalism. In other words, in fact, I think that's significant. I think that one of the things we need to consider about Work Keys is that even though it's a relatively new program, it's been in existence since I believe the early 90s. I think the research among corporate leaders throughout the country that led ACT, the American College Testing, to develop the Work Keys program occurred in the late 80s, and then the program itself was launched in the early 90s and has been updated a number of times since then. I really do believe it's a tremendous program. But on the other hand, given the kinds of problems and challenges that Richard Sennett has laid out for us as part of the new capitalism, I don't think that it's a program, at least as it's currently being implemented, that can address many of these issues. In fact, it kind of dodges a number of these issues. But one of the things that I point out, and I think this is very significant. From the very beginning, if you look at some of the upper level skills that the Work Keys program promotes and develops assessments for, you can begin to see that the upper levels of the Work Keys program from the very beginning were transitioning into what we call the higher order skills associated primarily with baccalaureate programs with traditional college education. That's the link or the transition that initially got me involved in Work Keys. And so I'd like to share some of that thinking with you and some of the specifics. In fact, I've taken the opportunity to select 3 or 4 of the skills. There are 8 particular skills that the Work Keys program features. I don't plan to go into depth on all 8 of them, and I'll explain why as we go along. But I did go into 3 or 4 of them, maybe 5. What I did was select an example from each of the 4 or 5 skills that I focused on. And what I'm looking at is one of the lower level skills and then one of the higher level of the same skill. And more particularly, what I'm hoping to accomplish here is to demonstrate why the lower level skill is lower level and why the upper level skill is upper level. And I think when you begin to digest and reflect upon the rationale, the explanation as to why a particular skill is considered to be at advanced level, given the example that I will share with you, then I think you begin to understand where the transition comes into the issue of education. However, I think that what Richard Sennett has given us in his brilliant analysis of the so-called new capitalism, I'm using that term as his because that was the title of his 2006 book, then I would suggest that the only way successfully that we can begin to move into seriously addressing some of the challenges that Richard Sennett lays out for us is to make the transition that is evidenced within the WorkKeys program. In other words, move into the issue of higher education, recognizing that the world of the new capitalism has pretty much forced us to take that final step. And what it means, I think, in the immediate short term for WorkKeys is that WorkKeys is going to have to move substantially into upgrading and rethinking many of these skills in order to be able to move along with the economy and with education as it addresses many of the problems that Richard Sennett identifies for us. So I think this is a particularly important program, at least in theory, because we'll find out at the end whether in fact it was successful or not, and I leave that decision up to you. But I think at least in theory, in plan, this is a good way to bring kind of together everything we looked at so far, because I think the WorkKeys program reveals to us some of the issues and some of the assumptions that really have wedded us, if you will, to tradition in our economic system, and why that particular idea and that particular definition of work, as it became more and more out of place in the new capitalism, has resulted in the kinds of skills, workplace skills deficiency, unemployment and underemployment that we have seen in our workplace as a result of the fact that the demands of the workplace have moved forward much more quickly than our training and education systems have been able to move in order to deal with those changes. So that's where I'd like to go today, and I'd love to hear you and your ideas, your concerns or suggestions about this particular topic, because this obviously is an issue in flux. I believe it's an important one, and I hope you agree that it is as well. If you would like to participate actively in our program by getting on the air, we would love to hear from you. I think during our program last Wednesday we heard from Horst in Taiwan, and every time we do hear from Horst, it really adds so much to the quality and the substance of the program. Horst seems to have a way of getting to the nitty-gritty of some of these issues. I may have thrown a lot of stuff out there, but Horst seems to be able to zero right in and cause us to focus on the priorities, and I appreciate that so much. If you would like to call and you would like to speak to our other listeners, those who are participating with us here at the Virtual Center, our phone number is area code 304-663-4676. That's 304-663-4676. 4676, of course, translating into HORN. If you'd like to communicate one-on-one with me via email, and a number of you continue to do that, and I appreciate it so much, my email address is waobrien906 @gmail.com. That's waobrien, OBRIEN, 906 @gmail.com. Before we get into the WorkKeys program and start to look at the specific skills, and I think the first one, which is locating information, and I say that as the first one only because it's the first one on the list I've put together. It doesn't necessarily suggest that there's a priority order here. I think each of the skills, once we identify them and if I can explain them adequately, I think you'll begin to recognize that it's not any one or two of these skills that are the most meaningful. All of these skills have their place in the contemporary workplace, even though that workplace is rapidly changing and I think is running too far ahead of the WorkKeys program's ability to catch up. But that's just me. And I didn't mean to imply there that I didn't think the WorkKeys program could catch up. I think it needs some serious revision and some serious thought in looking at a number of these skills, because I think a number of these skills are, at least the lower levels, are going to prepare workers with skills that, unfortunately, the jobs, the availability of opportunities to put these skills to work are becoming less and less frequent, less and less available. But before I do that, as I mentioned, I wanted to share, I received an email from a very, very close friend over the weekend. And besides the personal relationship that I have with this friend, who has been a confidant, a colleague, and a close friend for better than 20 years of mine, he's also a financial advisor full-time. He is, I think, at least in our community, one of the most reputable, highly considered, well thought of individuals in the area of financial advising. A number of people that I know have gone to him and have invested through him in retirement programs and IRAs and a number of other things. He's quite well thought of in the community. My guess is, and I think he'd probably kick me in the shins if he heard me say this, he's probably pretty successful. And the reason I say that is because he's so good. But to his credit, if he is successful, you'd never know that. He has not changed in the 20-some-odd years that I've known him one iota. But at the same time, he has become extremely successful. He's very, very much committed to the best interests of his clients, and I feel privileged to be one of those. Although I surely didn't give him one of the biggest account to work with that he's got. I'm sure he has a little bit of money to play with, but he's doing the best he can. And of course, the fact that he has my account means that he has to put up with me occasionally sending him an email through email or on the phone some sort of a blast about some of the things that I've seen in the economy, more specifically Wall Street. He and I have gone around and around on the issue of the stock market and the extent to which it is really gambling, and whether in fact it's giving big money, the big money players access to the small amounts that working people have to put in, and how unfair this is, in my view, to give a few people the opportunity to play games with the life savings and the retirement dreams of working people. I think this is a responsibility, unfortunately, that I think too many investors don't take seriously. The person that I'm talking about does take that responsibility very seriously, and that's one of the reasons that, even though we frequently disagree about the market and the ways we look at it, the fact of the matter is, however often I find myself disagreeing with him, has not diminished my respect for him one iota. I think if we had more people in the financial advising field like him, I think many of the things that go wrong or seem to go wrong, at least from my perspective, would right themselves. But that's just my own feeling. Anyway, I received a package of information in Friday's mail from him, and it was kind of an update on my own specific financial situation, and at least from the perspective that he sees, which is the funds that he has available to him. And as an insert or an enclosure in the mailing, he sent me the copy of an article, and I'm guessing that this is from a magazine of the investment corporation, a company that he works for, which is Ameriprise, I will say, because I'm not at all critical of this organization either. I think it's one of the major financial investment firms in the country, and he is the local representative here for Ameriprise, and I think one of the best ones. I think this article is probably from a magazine or a newsletter of some sort that Ameriprise puts out. And the reason I say that is because there's no other citation as to where the article came from, except the author and the internet site it came from. But according to this, the title of the category here is it's called The Client's Corner. So I'm assuming that if this is from a section of a publication called The Client's Corner, it's probably from some publication that the Ameriprise folks put out. But anyway, the title of the article is called The Horror of the Horror, a Litany of Equity Volatility. And of course what it talks about is the concerns that exist right now about the volatility in the market. Why am I sharing this with you? I think it's very, very important that I explain. I'm not just doing this because, for purposes of passing time. I think that many of the things we've talked about recently especially, but even further back than that, here at the Virtual Center, have focused on the whole issue of investment. We've talked a lot about the inequalities that there's no question are associated, however much is a matter of debate, but are associated clearly. The inequality that exists in our society and the concerns about it relate directly, no question, to the performance of the market. And the fact that some people do so well, other people don't do that well, and the fact that over the years, especially from the mid-'80s on, during the beginning specifically with the Tax Reform Act of 1986, that small investors, working people, were encouraged to shift their retirement thinking into retirement plans that they would own, into IRAs, 401ks, those kinds of things. And that was the beginning of the demise of pensions as we know them. And of course, pensions were guaranteed income programs where an employee, a worker, would contribute so much out of each paycheck, as you will, into retirement. And the money he put in would usually be doubled, sometimes tripled, by his employer. In other words, employers were paying or carrying the major portion of the retirement program for its own employees. The fact of the matter is, however, that retirement program was attached or connected to that particular place of employment. In other words, your retirement program remained your retirement program only so long as you continue to work there. If you bolted and resigned or quit your job in order to move somewhere else, you lost your retirement program. And there's no question that fact forced a lot of people who might leave their current places of employment in the 1970s and 1980s to stay. In other words, the investment in their retirement program had become lucrative enough that they couldn't afford to leave it, not unless they were going to a new position that paid so much and offered so much in retirement benefits that it made the risk, it minimized the risk of the move. For most people, in other words, their mobility, their ability to move within the economy as employees was limited by their own retirement programs, because the more lucrative it became, the more they were almost stuck, if you will, in a particular employment place because they couldn't afford to risk losing their retirement program, their pension. And one of the arguments that was used in the mid-'80s during, as a result of the Tax Reform Act of 1986 in order to get people thinking about investment, their own investment programs, IRAs and 401ks, and thereby to abandon their faith in pension plans, was this idea of mobility. I can remember President Bush, George Bush, the younger, during the early years of his administration, when he wasn't talking about Iraq, of course, talking about how one's freedom as an employee was tied directly to control over his own retirement program. In other words, by getting your employer out of your retirement package or your retirement picture, you became the sole owner of your retirement program. It became your commodity owned by you. And that meant that if you changed employers, you could take your retirement program with you. So it enhanced flexibility and mobility in the workplace. And that was a major selling point that encouraged people to abandon pensions in support of 401ks. And so in the late 80s and early 90s, and then in the mid-90s, public sector employees began to experience the same advertising pitch, or the same sales pitch, if you will, from municipal employers, from cities and counties and state governments and whatever, that, you had a choice. You could stay in the current pension program, or you could take your money and move it into one of these retirement programs that you owned, and it would give you flexibility and mobility in the market. And of course, that flexibility and mobility within the marketplace is exactly what Richard Sennett was talking about as a key part of the new capitalism, which is about the demands for mobility within the market, not only for employees, but for employers as well. Employers wanted more mobility, more flexibility in the way they dealt with you as an employee. And so by combining this whole package, this major sales job occurred where millions of working Americans chose willingly to opt out of pension plans and were lured into the market. And of course, what lured them into the market as much as anything else, in fact, more than anything else, was the incentive of returns on investments, on stocks. That was 6, 7, 8, 10, 12, 13%. I mean, people would read about these all the time, how people were realizing 12 and 13% returns on their investments in the market, and working people began to say, heck, I can do a lot better with my pension money by investing it in the market and gaining access to some of those lucrative returns. I can become an investor. And a lot of people did, and many people were successful doing it. There's no question. But a lot of people were not. Because the fact of the matter is, investing in the market is not a game. In large part, it's a skill. It's something you learn and you have to be good at and you have to be careful. Because like any other gambling situation, yes, you can win, but you can also lose. And if you gamble big, you can lose big as well as win big. And a lot of people did. Especially in the recession, the 2007 to 2009 recession we experienced at the start of the Obama administration. And we realized that when the market was reeling as a result of the bursting of the bubble of the real estate market and all the rest of it. A lot of people, a lot of good people got hurt during that recession. People who know the market and understand the market are well aware that there are ups and downs, there are recessions, there are bull markets, but there are also bear markets, which of course is the exact opposite. I mean, there are times when people do well, and there are other times when people have to be very careful. Okay. This particular article that I'm talking about is this author's effort, and I will identify the author because his name is Nick Murray. His name is Nick Murray. And this article is brand new. It was written in May of 2015. And, excuse me, I'm hearing a noise on the internet that I don't understand, so I'm going to get rid of it. This article is written by Nick Murray, and Nick Murray identifies himself as a financial advisor who's been in the business for 48 years. So obviously, this article is written by a person whose entire professional career was spent in advising people about the market. And there were a couple of reasons why I thought that this particular article would be valuable here at the Virtual Center for us to spend some time on today. One is the information, and I'll share that with you in a second, but I think the information is fantastic. I think the article is a keeper, in other words, because of the information it contained. It pulls together information that I think anybody that wants to comment on the market over in the last 25, 30, 35 years can basically pull out the needed information in this one article, and I think that makes it quite valuable. That's one factor. The other factor that I think makes this so significant is that this particular article, it seems to me, addresses directly or indirectly, many of the concerns and the issues and the insights that we've been dealing with in recent weeks, and we've been talking about the nature of the new capitalism, the nature of the economy, and the transition to the market of more and more people. I think all of this is significant. Most appropriately, what this article seeks to do is calm the fears of investors who have become quite concerned in recent years over the volatility of the market. And that particular issue is one that I would like to take particular time on, because I think the author is correct. I think a number of people, especially after the recession that really hit in 07 and 09, and the recovery that has been slowly taking place during the first Obama administration and is continuing into the second Obama administration, we have gradually recovered stability in the economy. But the depth, the severity of the recession and the damage that it did for millions of people, many of them who lost their homes, many of them who lost their, significant portion of their retirement funds. And because they are retired, they don't have the opportunity to recover from these kinds of setbacks. I think that has created a fear about the market and about the stability of the market that is rippling through the financial community. It's scaring a lot of the banks and investment companies because people are so skeptical of the market. They've become less trusting of the market. Therefore, those that believe firmly in the strength and stability of the market are coming to its defense, and that's what this article is about. And I think the author tells us right at the outset that he has 48 years in the financial advisory profession, and so therefore he knows whereof he speaks. And what he does is address this issue of volatility, instability. And he basically points out that if you go back, and he begins in 1980, over the last 35 years, from 1980 until 2015, the last 35 years, you begin to see a pattern of volatility. And he's very careful, and I think this is very, very shrewd on his part. He's very careful to point out that volatility does not only mean drops in the market. It also means elevations in the market. Volatility is instability. It's extreme ups and extreme downs, not just downs. And he points out that a lot of people define volatility as down a lot in a very big hurry in a short time. But his point is volatility can go up as well as down. And he points out over the last 35 years there's been significant volatility in the market. And in fact, he points out that within that 35-year period, from year to year, one can expect to lose 14% of their investment the first year. That in other words, it usually takes time, and more often than not, people sometimes experience negative cash flow, if you will, or investment flow in the first couple of years they're in the market. What he points out is that during these 35 years, the average intra-year decline in the S&P 500 was in excess of 14%. And he gets his numbers from the S&P Standard & Poor's index itself. In some years, he says, the index declined less than 14%. In some years, it declined more. But the average was 14%. And he points out that during these 35 years, there were 7 bear markets. Bear markets, B-E-A-R. That's what I was talking about before between bull markets and bear markets. Bear markets are the down markets. And he says during that 35-year period, there have been 7 bear markets. And the way he defines a bear market is a decline of at least 20% in the S&P index. He's not talking Dow here. He's talking Standard & Poor's index. And his point is that if in a particular period there's a drop in the S&P of 20% or more, then he considers that a bear market. And he said there are 7 of those during the 35-year period that he's covering from 1980 up to the present. And then he proceeds in this, and this is the bulk of the article in terms of space, then he proceeds to give us the details of each one of those 7. So when I said at the beginning that the information included makes this a keeper, that's what I'm talking about. In this article, he has identified the 7 bear markets over the last 35 years. And he's given us the numbers from S&P to indicate that it was a bear market. And he's basically identified a couple of the things that were going on during that period that at least financial advisors like himself believe caused the market to decline during that period. I'm not going to go through all 7 because I don't want our program here, especially since it's the last one it'd be the last one over the next week. I don't want all of it to be consumed with the details of these particular 7 periods. However, I would like to indicate a couple of things because I think many of us who are listening to the Virtual Center right now who are old enough to remember much of this. I know I do. And we can remember what was going on when and how it was reflected and what was going on in the market. In other words, what was happening to people's investments as the market responded to the world in which we find ourselves living. The first one he mentions is November of 1980 to August of 1982. you'll recall that November of 1980 is the election of Ronald Reagan for the first term. And so from November of 92 until August, from November of 1980 until August of 1982 is the first 2 years of President Reagan's first administration. Many of you will remember that President Reagan's arrival in office in January of 1981, after the November elections of 1980s, followed the administration of Jimmy Carter. And many of you will remember, as I do, the Iranian hostage crisis in the Carter administration, and the extent to which the oil embargo that the world experienced during this period and the nation experienced drove the price of oil up to incredibly high levels. And there's no question that the combination of the high prices and inflation caused by the oil embargo, coupled with the holding of American hostages during the Carter administration, no question, those two things, as much as anything else, led to the defeat of Jimmy Carter for re-election in the election of 1980. There's no question that it almost gave the 1980 election to Ronald Reagan. And of course, many of you will remember the results of the election. It was a landslide. In other words, the 1980 election was not so much an election for Ronald Reagan as it was an election against Jimmy Carter. And many of you will also remember that the hostages were released on the day that President Reagan was inaugurated. And you may remember as well that the hostages were not released until after the inauguration. In other words, those holding the hostages wanted to send the message that the hostages were being released, in part because Ronald Reagan was elected and not Jimmy Carter. Over the next 2 years then, when President Reagan took office, he was dealing with the outcome of extremely high inflation and the damage that this situation had done to the economy. And at that time, the new chairman of the Fed was Paul Volcker. And many of you may remember that Paul Volcker was charged with breaking the high inflation of the 1970s, the tremendously high inflation rate. I can remember during that period, my wife was in real estate in Virginia at that time. Interest rates on loans, on 30-year loans, were 16 and 17%. I can remember how difficult it was for realtors to sell a house during that period because the interest rates were so high. And Paul Volcker was given the task by President Reagan, by the Reagan administration, to do something about this. And what Volcker did, of course, was implement policies at the Fed to put the brakes on the economy, to intentionally clear that was, but it did kind of jerk the economy back into a sense of reality. And the interest rates, of course, have never gotten anywhere near those levels since. This was the period when President Reagan began to sell the idea of trickle down, and we were introduced to the name of David Stockman and all the rest of it, and we know all about that. The point was that during that period, the Standard & Poor's index, the S&P index, was down 27%. So that clearly was a period that you could identify or define as a bear market, because the drop in the S&P percent. I mean, this is really good information should any of us ever need it for anything. The second bear market that that the author identifies is from August 1987 to December 1987. Now, of course, you can pretty well see that August to December in the same year is 5 months. So what we're talking about here is a decline in a very short period of time. In other words, this is not a drop of 27% that stretches over 2 years. This is a drop of 34% that happens in a period of months. Not only that, but on Monday, October 19th of that year, 1987, so-called Black, and the author makes mention that during that day, Warren Buffett lost $347 million in one day. $347 million. However, the author points out that Warren Buffett, quote, appeared strangely unperturbed, unquote. Now, of course, the reality is part of the reason he was a bit less perturbed than we would be is because if he lost $347 million in one day, it was, it reflected a minor portion of his entire worth. So in other words, he had enough to fall back on. Most of us wouldn't. And so most of us obviously don't have $347 million to lose. But whatever that equivalent is for us as individuals, we don't have the fallback funds that Warren Buffett had. So I think that explains it. But I also think the fact that he points that out about Warren Buffett and how much faith Warren Buffett had in the market to rebound to the point that he wasn't all that disturbed is the point of this essay. In other words, the author wants us to see that even a major investor like Warren Buffett said, just stay cool, hang on, it'll come back. And then he takes us through others. July of 1990 to October 1990. July 98 to August 98. And then, of course, he takes us to the administration of George Bush. March 2000 to October 2000. During that period, from March until October, from March 2000 until October 2002, 2 years and a half, the first 2.5 years of President Bush's administration, the index went down 49%. And the explanation, according to the author, the implosion of the greatest stock market bubble of all time, the Internet mania. This, up until that time, this was the largest stock market decline since the crash of 1929. And then, that was in the first couple of years of President Bush's administration. Then the next bear market was October 07 to March of 2009. Again, another 2.5 year period. The index went down 57%. This followed the Great Recession. This was the drop that was the Great Recession, the burst of the housing bubble, and this is the one that greeted President Obama when he came into office in January of 2009. And then the last one, the seventh one he identifies, is April 2011 to October 2011. So that's 6 months during the year 2011. The market went down not quite 20%. The S&P went down not quite 20%. That went down 19.4% during that period. And of course, this was attributable in large part to the issue of terror, the challenge of the euro and what's going on there, and the government shutdown, and the prospects that the U.S. Treasury would default on its bonds, the first downgrade of U.S. debt since Alexander Hamilton served as Secretary of the Treasury. Those are the 7 that this author identifies. And then he basically looks over the 35-year period that those 7 bear markets cover. And he says the following: an average over this period of a 14% hit to your capital annually, whether you need it or not, and an average of nearly a 1/3 decline every 1 year in 5. So what's the message? The message is that despite the periodic bear markets, as it were, the market still remains the investment of first choice for people who know what they're doing. That's the message of the article, is to hang in there and don't lose faith. And because this article responds to the fears that exist. And then finally, at the very end, the very last paragraph of this article, and I want to share this with you, and then I want to make a few comments about it, he says the following: the Standard & Poor's 500 stock index came into 1980, right at the beginning of this relentless litany of unspeakable horror, at 106. In other words, when this period began in 1980, this 35-year period, the SP index stood at 106. It went out at the end of 2014 at 2,059. That's right. Even as the world appeared to be ending on no fewer than 7 separate occasions, the S&P 500 went up pretty close to 20 times during that same period. And that's not counting the dividends. The message, in spite of things looking bad, if you give it time, it'll all be okay. That's the message. I think it's a fantastic piece for the information that it gives us. I think it ignores a lot of issues and a lot of things, which I think create a little bit less clarity in the points that he's making. For example, the transition from pensions to 401ks and IRAs that I was referring to earlier. The result of this transition, which began in the 80s, in 1986, at the beginning, at the beginning of President Reagan's, in the midst of President Reagan's second term in the second Reagan administration. And what the result of that transition, at least in part, not the total result, but one of the results of the Tax Reform Act of 1986 was the infusion of tens of millions of dollars that heretofore had been invested by corporations in employee pensions that now found themselves in the market in the form of IRAs and 401ks. So this tremendous increase in numbers from 106 in 1980 to 2059 in 2015 is at least in part the product of the injection of tens of millions of dollars in worker retirement money that used to go into pensions for their retirement and now becomes chips, if you will, in the game, in the investment game of the stock market. And then in the 90s, tens of millions of dollars more in retirement money of state employees, public employees, is invested in the market when the same transition from pensions into 401k programs and IRAs takes place in the public sector market as well. What that means is that state pension funds for public employees that used to sit earning interest in banks and would earmark to pay the pensions of retirees now ended up being invested in the market by government themselves, by state and municipal governments themselves. Government went into the business of playing the stock market, and they were using the money that had been allocated for retirements. And so consequently, while the overall performance of the market may have been good during that period, the fact of the matter is many states took on debt that they couldn't pay because every one of these investments didn't necessarily pan out. I mean, when the investment happened and all of these people that we hear about were damaged, some of them irreparably, in their retirement funds and all, what does that mean? That means that the recession hit the investors, which meant it hit the public investors as well as the private ones. Now what we see are conservative candidates for office, many of them governors like Scott Walker of Wisconsin, like Bobby Jindal of Louisiana, who are cutting back on state obligations to their own employees because their argument goes the state was overgenerous. It made commitments to workers that there's no way the taxpayers of the particular state in question can meet, can address. And the fact of the matter is, a lot of this is because the money was going to a different place. And we're still feeling the effects of the last couple of bear markets. So I think there's a number of things that occurred and affected this story that aren't included in the article itself, but that does not detract from the quality and the usefulness of the article for the information that it supports. I emailed my friend this morning after reading the article. I read it 3 times this weekend, and I thanked him for it, and I pointed out a few of the things that I saw that were omitted from consideration here. But at the same time, I thanked him for sending the article, because I think it's valuable, and I think it's something that all of us need to be aware of and all of us need to know. I think one of the issues is, and I've heard debates on this on terrestrial talk radio and on other internet programs, etc., is the idea that it's our money, and if we're stupid enough to risk it in risky investments and we lose, so be it. That's the name of the game. Fact of the matter is, when this whole idea was sold to working people, it was sold on the idea that it's a game that people, for the most part, can't lose in. Fact of the matter is, we know now they can. One other thing that I think is significant here is the selection of the 35-year period. That's a little bit arbitrary. I mean, and that kind of suggests how you can manipulate how you can make the numbers say pretty much what you want to say. The example that I use, for example, is if you're buying a car. If you go to the lot and you find the perfect new car, and when all the numbers are in, you find out that financing this car over a 60-month period, 5 years, is going to cost you more per month than you can afford, you don't buy the car. One way to change the situation is to extend the funding from 5 years to 6 years. In other words, from 60 months to 72 months. And if you take that same car and you spread the payments over 72 months rather than 60 months, then the per month payment becomes much lower. And chances are you can afford the car if it's financed over 72 months when you couldn't afford it when financed over 60 months. The price of the car hasn't changed. In fact, chances are the price of the car has actually gone up because it's lost in the financing. But again, by changing the range, by changing the divisor, the number of months you divide into the total payment, you can make the numbers go up and down as you will. That's why car dealers oftentimes will offer a premium, a real reduction if you go in and pay cash for the car, or if you go in and you finance it for 3 years. I can remember in the 1950s when I bought my first car, 36 months was the average time to finance a car. I can remember my first car was financed for 36 months and my payment was $53 a month. I thought it was a fortune. But 3 years became 4 years, became 60 months, is now becoming 72 months in order to keep the price of automobiles, which continue to escalate, within the reach. And of course, the biggest draw that the auto industry has come up with is the leasing program. We won't get into that, but that's and that lowers the price substantially until you own the car for 3 years or whatever, and then by the time you're 3 years in, that's when you find out what the real cost of the car to you is going to be. Anyway, I think this is a very, very valuable piece of information, and I think it fits here very well because it's part of the economic environment that we live in that Richard Sennett told us about in the so-called New Capitalism. And I think it's very important to keep in mind. In other words, there are a lot of factors. This isn't just a theory. This isn't just a financial theory. This is a real situation where real people are making real decisions, political decisions and economic decisions, which affect all the people involved. And finally, as a parting, concluding comment on this, let me say that this entire piece, the over 35-year coverage of the 7 different bear markets during that period, all of them tend to assume, the author tends to assume, that these things happen automatically, that people don't make human decisions and political decisions which affect performance, when in fact we know that's not true. The transition from pensions to IRAs and 401ks is an example of a major political decision made by government that changed the whole game of investment in the stock market. So while the author is asking us to look over the entire 35-year period, the implication is that while there are periodic ups and downs, the overall mechanism self-adjusts. And it's an automatic mechanism that will ultimately benefit us if we're willing to wait long enough. And the best example, of course, that he uses is Warren Buffett's loss of $347 million on the 19th of October, 1987. But the reality is most of us aren't Warren Buffett's. We can't afford to put $347 million out there on the, in risky investments. But on the other hand, what makes him able to do it is the fact that he's got many times that to fall back on, and the rest of us do not. So I think this idea that the market functions automatically, that there are automatic triggers and readjustments in the market which makes long-term performance guaranteed profit if people are willing to wait long enough, I think is a reliance on faith that many of us can't afford the luxury of waiting on. At least that's my own feeling. We've gone beyond the top of the hour. It's 5 minutes after the hour, 5 minutes after 2 in the East. If you bear with us while we take a 5-minute break, and we'll come back and we'll spend the bulk of this hour on the Work Keys program. This is Bill O'Brien. You're listening to the Virtual Center for the Study of the Constitution and Civic Responsibility. Please hang in there with us. We'll take a 5-minute break, then we'll be right back. Thank you.
A little something from Duke Ellington and Charlie Mingus entitled Money Jungle. I thought it would be appropriate, Dr. Bill.
Bob, it is. It's fabulous. Thank you. Money Jungle. Wow. Man, you're good, Bob. Thank you.
No problem.
Okay. Are we back on?
Oh, yes, quite.
Okay, we're ready to go. Thank you. Welcome to the second hour of the Virtual Center for the Study of the Constitution and Civic Responsibility. This is, excuse me, this is Bill O'Brien, and I had a glass of water in my hand, and it went down the wrong way, and I apologize. This is our second hour, and we wanted to spend our time focusing on the transition from skills to what I believe is higher education. During this our last hour together, and a reminder that we will not be doing a program either tomorrow or Wednesday. So our next time together live here at the Virtual Center will be a week from today on next Monday. Our phone number is area code 304-663-4676. 304-663-4676. My email address, waobrien906@gmail.com. waobrien, O-B-R-I-E-N, 906@gmail.com. As an introduction to this issue by introducing the Work Keys skills, I want to read once again for you a passage that I wrote, which is that I put together, which seems to me to indicate what we're going to see within these Work Keys skills. So I'm quoting myself here. Ironically, greater skill and adaptability demands of the 21st century workplace have accomplished what academic theorists and worksite practitioners have never been able to accomplish. The transition from skill demands defined and driven by the immediate requirements of the job and addressed on-site to more abstract, multifaceted planning and problem solving, most often undertaken in labs, on drawing boards, by teams employing the most sophisticated cognitive applications usually associated with the classroom. At long last, education and training, the instructional twain that could never meet, now has. And of course, the issue of immediate requirements of the job addressed on site. When we talk about on site addressing specific requirements of a job, we're talking about training. When we talk about education, we're talking about something a little bit different, something that takes longer, something that is more abstract, something that is multifaceted, and something that oftentimes happens before you hit the workplace rather than after you get there. And I think all of us are familiar with the debate that consistently continues to go on between those who claim that higher education's first priority ought to be prepare people for work, for higher education and quality of life issues and careers, as opposed to those that believe that the purpose of education goes beyond a particular job or a particular career or a particular set of skills And we continue to have that debate. And of course, there's no question, as we see the humanities and the arts continually taking a beating in state after state education programs, we're beginning to see that the career issues and concerns appear to be winning out, at least for the present. And I think with the opposition to the Common Core that is growing, I think we're beginning to see more and more of this. But this is another issue. The WorkKeys program, again, was developed as a product of research done in the 80s, in the 1980s. It was a program launched by ACT, the American College Testing, in the 90s. And the result of the research was to identify the skills most in demand in contemporary, at the time in the 80s and 90s, in the contemporary workplace. And the biggest selling point, feature, if you will, during the 90s was the idea that we were on the cusp of the millennium. We were moving into a new millennium, into the 21st century. And the changes that were taking place in the workplace were going to require increasingly higher and higher skill demands on workers. And the WorkKeys program was designed principally to identify skill deficiencies so that trainers and educators could develop training and education programs to address those deficiencies and correct them. So the 8 skills in question were broken down into different levels of that particular skill. And so what I wanted to do is first of all, identify the skills themselves, which I think I've done before here at the Virtual Center. And then I'd like to provide examples of lower levels of those skills and compare them with upper levels of those skills, complete with an explanation as to what makes the lower level skills lower level and what makes the upper level skills upper level. In other words, why is this a 3, level 3, and that's a level 6, for example, in each of the 8 skills we're looking at. So let me begin by just running down the list of the 8 skills in question. Then we'll go back and we'll look at 3 or 4 of them, look at examples of lower and upper level skills in order to understand the transition taking place when one is able to perform a particular skill at an advanced level. Then the thinking behind WorkKeys is that employee becomes more in demand, becomes more critical to success in the workplace, the employee's success and also the employer's success. My concern is that when you get into the upper levels of some of these skills, it's one thing to identify the deficiency, and WorkKeys is able to do that. But it's quite another thing to address those deficiencies. And I would argue that at the upper levels, training really can't address the deficiencies, only education can. And it seems to me that's the transition we've made as we move into the 21st century. More and more of the skill deficiencies being measured in the WorkKeys program require remediation that can't happen in the short term on site in the workplace. Rather, by the time particular work has reached the skill levels being demanded of workers at the upper levels, we've moved into a totally new ballgame. And it requires workers who have had at least some education at the higher education level. Because what we're talking about here are issues related to things like insight and innuendo and assumptions and intent. We're talking about the ability, we're talking about insight. We're talking about the abilities to hypothesize problems. We're talking about getting employees who are so skilled and so highly educated that they can see things happening that most of us would never see. They can project down the road and anticipate problems that are liable to arise if corrections aren't made in the interim. And then they are able to introduce or apply those corrections in such a way to avoid a problem. And what the employer is demanding, and this is where Richard Sennett earns his stripes, so to speak, what the employer is finding is that more and more of the skills that are demanded out there require higher and higher levels of abstraction. And once we get into the field, the area of abstraction, we've gone beyond the ability of the employee sitting in a training classroom looking at a problem and learning how to solve it. The solutions to the problems confronting the workplace now aren't solvable in one 8-hour training session, because they demand the ability of the worker to make accommodations, to be flexible in the way that the worker addresses problems and defines potential solutions, to be adaptable, to be mobile, to be able to work in teams with others, to be able to bring together the variety of different people with different levels of expertise in different areas and bring them all together as a team on the same problem in order to solve it. In other words, the workplace is demanding solutions to problems which are no longer available in the traditional training classroom. What we're talking about here is the demand for a totally different level of worker as we move into the last quarter of the first fifth of the 21st century. In other words, we're 15 years in. So with that, let me identify the specific skill areas that WorkKeys has identified and do the best I can to explain what they are, because in some cases I think the explanation, the definition of what they are is very important. And then look at a couple of examples. The one that we looked at, I believe, last week, is locating information from the higher education perspective side of the fence, if you will. It would be termed research skills. Locating information. Ultimately, what that means is, once you see a problem, knowing where to go in order to find solutions to that problem. What information do you need to collect in order to have a chance of solving a particular problem? That's the skill of locating information. And again, putting this in context, what employers were telling WorkKeys researchers is that we need employees who can not only spot a problem, but can also know where to go and what they need in order to solve that problem. We don't need just people who can identify problems. We need people who can solve them. And what that implies, of course, is we need people who are able to make independent decisions on the job, on the fly, so to speak. We don't need employees who see a problem, notify somebody, and wait for somebody else to come in and solve it. We no longer can handle employees who do what they're supposed to do, and if anything changes or anything goes wrong, they just stand there and wait for somebody to tell them what to do. We need employees who can do, who can think, who can solve problems, who can define them, and who know where to go in order to find the information they need in order to solve these problems. That's what employers mean by locating information. Second area, applied mathematics. Emphasis not so much on math, emphasis on applied, on applications. We need employees who don't just know how to solve equations and solve problems. I didn't mean that. Who can just solve equations. We need people who can apply the knowledge that mathematics gives us to different situations. We need people who can not just do, we need people who understand. People who can apply mathematics, can apply the knowledge and the wisdom that mathematics gives us. The accuracy, the numeracy, the ability to reduce problems to numbers. The ability to translate issues or problems from one language into a common language that everybody knows, which is math. I mean, this is really what coding is about, it seems to me, is getting employees who can handle symbols. This symbol stands for that, and this stands for that. And so therefore, we talk all the time about, in computer science, we talked about people who can program, who can put together the symbols and write entire internet computer programs in a language that the novice can't understand. All of that is part of the principle of applied math. But of course, at the lower levels, it's basic applications. At the higher levels, it's something substantially more than that. Third area, third skill, reading for information. Reading well enough to be able to learn the content of what's in what you read. The idea being that if you run into a problem, or if as an employee you're given written instructions, you need to be able to read the instructions well enough to know what to do on the job. You need to be able to read well enough to extract the key information, the relevant information from what you're reading. You need to be able to read manuals and how-to manuals. And any of you have ever bought anything that needed assembly? You need the instructions. And you take A and you fit it into B and all of these other things. You've all done that. We've all done that and driven ourselves crazy, putting children's toys together and various other things at Christmas time. We need employees who can read well enough to be able to extract the information they need from written text so that they'll know what to do. The implication is that their performance on the job is directly connected to the instructions given to them. The idea is that somebody is telling them in written form, this is what we want you to do on this job. And you're able to take those written instructions, extract the information from those instructions that you need, and then perform. Of course, the problem is that more and more of the jobs that we have today put us in situations where the answers to what we do aren't written, because there are so many unexpecteds in the kinds of jobs we do today that many of us end up having to make decisions on the fly. And no matter what we go to, there's nobody that's written down and able to tell us what to do, because they didn't anticipate the problem we're having now. Consequently, we need people who perform at a level above what a manual tells them to do. That's reading for information. What we need today is what we often refer to as reading for understanding. We need people who can understand what they read, understand the problems confronting the workplace, and know how to act accordingly without somebody coming to help them and telling them what to do. We need employees who are skilled enough to be decision makers, not just followers of instructions. So on the lower levels, reading for information is being able to read basic information, get what you need from it, and then perform what it tells you. But obviously, at the upper levels, reading for information requires more than that. It requires understanding what you're reading well enough that you can answer questions that aren't directly answered in black and white in the text. You've got to infer the answer from what the written text tells you. You've got to make, quote, educated guesses. This is what I do given what the information that I have at my disposal tells me I need to do. That's reading for information. A fourth one, and obviously a key one, relates to technology. But more specifically, this particular skill is applied technology. The ability to understand the basic principles of technology. What do I mean here? I mean the basics of engineering, the basics of electricity, the basics of carpentry. Being able to understand the basic principles of structure and strength and tension and all of these other things, and then being able to apply them to the workplace, to the particular job that you are responsible for. So applied math and now applied technology. Think of those in today's workplace, and I think you'll get pretty much what this program is about. A fifth skill is called business writing. In the 90s, when I was directly involved in the WorkKeys program, and if I have time, I'll explain that in a moment. It used to be just called writing, but now it's referred specifically, it's called business writing. And what this means is being able to handle on-the-job written instructions, not just reading for information. We're talking now not about reading, but about writing. Being able to write in a way which communicates what you want to say to the person reading what you are writing. We need people who can write well enough and clearly enough that they can communicate. And of course, increasingly, that's technological writing. The old idea of writing out longhand is long gone. We're talking about people who can sit down at a computer and bang out particular communication information and suggestions in order to be able to communicate with other people in writing. The key measure, of course, is not on how well you think you write. The key determiner, the key assessment, is on the degree to which the people who receive it can understand what you're saying. I would suggest to you, if you think about all the discussion we have about standardized testing in our K-12 schools and all the rest of it, we're not turning out people who can write that well. I've been teaching history for half a century, and I've always given essay exams and projects, research projects, where students have to give me information in writing. They have to do research. They have to take information and use it to argue a point of view. They not only need to know what they're talking about, but they need to be able to write in a way which allows me, the instructor, to understand what they're saying in order to evaluate whether in fact they know what they're talking about. How well they know what they're supposed to know, I measure by how they tell me in writing what they know. And that's the major deficiency. Some of the best students that I've ever had in terms of insight and ability to think and ability to function in the abstract can't communicate in writing. They can't write well enough to communicate what they know. So what Werkes calls business writing is a very important skill. Listening for understanding. This is a relatively new skill in the Werkes lexicon. The skill used to be just called listening. And how many times do we hear people talk all the time about what part of the problems we have in today's world is that people just don't listen? And of course, when we have debates or we have arguments or disagreements on points of view, we'd like to believe that both sides are listening to each other so that in the process they're both learning from each other. That's what we'd like to believe. But that implies that people are listening to each other. More often what we find is that while one side is talking, the other side is preparing the comeback and therefore not really listening. And so consequently, listening tends to go by the board, and what ought to be real conversation and dialogue leading to the solution of a problem instead becomes a debate as to see which side wins and which side loses. We have got to get away from that. So the new skill is called listening for understanding. It's not a skill that I can give you an example of because it requires audio capability. In other words, what we have here is that people are given audio instructions, are asked to listen to a piece of information or listen to the spoken word, and then to turn around and write what they think they heard in a way which communicates what they want to say and in a way which reveals that they really understood what they were hearing. In other words, the skill here, obviously, is putting much more emphasis on listening to each other. Communication in the workplace, interpersonal skills, all these things that we talk about in education and surveys and research that the Pew and other organized groups conduct for us that tells us why our workplace is experiencing such problems. And then the seventh skill is teamwork. Teamwork. The ability to work with other people. The ability to get along. The ability or the willingness to compromise. This also is a technology-driven assessment. And what I mean is the WorkKeys folks have put together video vignettes of teams theoretically working on a problem or a project in the workplace, whatever kind of workplace it is. And what you, the worker, the person taking the assessment, are asked to do is suggest the problems to teamwork and the people. In other words, you have to identify, after watching the vignettes, which people are making teamwork difficult and which people in the video seem to be contributing to the ability of the group to work together in order to solve a problem. And depending on the skill level, as the skill goes up, the video becomes much more complex and much more complicated. And therefore the assessment becomes much more complicated. It asks us for an analysis of the video that is much more in depth, much more involved, much more complex, much more insightful. And then the eighth skill, the final one, is called workplace observation. This one I think I mentioned the other day in our last program. Workplace observation is the ability on the job to spot little things, to be observant, to not miss clues, to be able to solve the episodes of Columbo as fast as Columbo does. What we're looking for are people whose observation skills, whose ability to spot details is sharpened. And of course, if you move up the level of skills from lower level to upper level, observation morphs into anticipation. In other words, instead of observing something that is already a fact, the upper level skill asks you to be able to anticipate a problem even though all the information is not given there. You are able to deduce, to draw implications, to understand the process so well that you can predict. And you can see problems that other people wouldn't be able to see. Those are the 8 skills. And it seems to me that, and I'm kind of keeping an eye on our time here, it seems to me that as you look at those skills together, all 8 of them, you can begin to see where the contemporary workplace is taking us. What it is that employers are looking for in employees. And why it is that they're having so much trouble finding good employees. And without getting off track here, let me point out that in looking for employees who have these skills at a fairly sophisticated level, then the next step would be to look to our schools and look to our colleges and universities to turn out people who have these skills. Why can't our education community, K through 12 or higher than K through 12, why can't they turn out potential workers who can do this stuff and do it well? So we get back to the question, how do we teach these skills? the basic levels, you can teach them in training. You just bring the employees together and you do it in a training workshop, and they do the same thing over again, and you give them a short answer fill in, true or false thing, and when they get 10 out of 10, they qualify, and the training's over. But the fact of the matter is the problems and the complexity of the problems that workers encounter in the new changing workplace of the new capitalism demand skills and levels of abstraction, insight, observation, research skills, and all the rest of it that we haven't successfully found a way to solve or address in the training sessions, on-site training sessions. What we're looking for are the kinds of well-educated, talented students to come out of our colleges and universities who come already equipped with these skills. And that means we need an education system, K through 12 or higher education, that knows what the skills are, knows how to teach them. There, I would suggest, ladies and gentlemen, folks, is the breakdown, is the problem. We don't have teachers and faculty members in our colleges and universities that have a clue about this stuff, because this is all considered non-academic. This is on our higher education campuses, all this stuff is considered training, pre-education, below the levels of education. We operate at levels above that. And that's the barrier, that's the transition or the communication deadlock that heretofore we've not been able to solve. I think the new capitalism, as Richard Sennett has explained it to us, goes a long way into telling us and showing us how we need, why we need to find a way to take career and workplace education to the next level. And we've got to begin to prepare our educators to do it. The best framework that I've ever seen for making this happen, or at least beginning to make this happen, are the Common Core standards. But as we know, the Common Core is confronting all sorts of obstacles and political barriers, which are making the transition to the Common Core a lot more bumpy and a lot less predictable than at first, when it was developed in 2010, we thought it would be. Let me take the last 15 minutes or so, it's actually about 12 minutes, to give you a couple of examples of some of the skills in a few of these areas. I can't give you the audio or the video ones, obviously. But here's one, applied math. The lowest level is level 3. Now you might say, why did they begin at level 3? Why is that the low? Why isn't it level 1? Because WorkKeys is based on the premise that every worker must have some skills. In other words, even level 3, which is the beginning level of the WorkKeys program, is seen as the minimal performance level acceptable in the workplace. Anything lower than 3, you shouldn't even have the job. So the minimal level for assessment purposes is level 3. Here's an example. This is going to sound like your old arithmetic classes. In your job as a cashier, a customer gives you a $20 bill to pay for a can of coffee that costs $3.84. How much change should you give back? And then it gives 5 possible answers. Your job is to select the right answer. Why is that level 3? Why is that the basic level? Because it requires only one particular mathematical activity, namely subtracting $3.84 from $20 bill, It's not, there's not a complicated set of facts to work your way through. It's very simple. A customer buys a product for $3.84 and gives you a $20 bill. How much do you owe them back? Very simple, basic stuff. But you got to be able to do it. If you can't do it, you can't do the job at all. All right. What about level 7, which is the highest level of math application? Well, I can't show you this, but if you look online, you can find this with a diagram as well. The farm where you just started working has a vertical cylindrical oil tank that is 2.5 feet across on the inside. The depth of the oil in the tank is 2 feet. If 1 cubic foot of space holds 7.48 gallons, about how many gallons of oil are left in the tank? In other words, if you are delivering oil to this particular tank, you have to start by measuring how much is in there in order to know how much the tank will take. How do you do that? Why is this a level 7? Well, first of all, there are multiple different steps of calculation. You have to do a lot of calculations here. You have to look up and use the formula for the volume of a cylinder. You've got to be able to know how to determine the volume of a cylinder in order to find out how many gallons it'll hold total. Then you have to convert from cubic feet into gallons. So the level of sophistication and what you need to know in order to solve this problem is at a higher level. So if you're interviewing an employee and your employee is going to have to do this kind of stuff, then you give him a few of these problems and then you can measure what that person's skill level is currently at and how much training will be necessary in order to elevate that skill level so that the person can be qualified to take this particular job. The point is that many of the jobs in today's workplace require more than training. Reading for information. We talked about reading for information. All right, here's a level 3. Here's the basic level. And remember, there are 2 levels below this. Theoretically, if you can't do a level 3, then you can't have, you don't even belong in the workplace. All right. And I'm going to do this quickly because we're running out of time. It's a passage entitled Attention Cashiers. All store employees will now get 20% off the price of clothes they buy here. Please follow the new directions listed below. Selling clothes to fellow employees. 1. Ask to see the employee's store identification card in order to ensure that they're an employee. 2. Enter the employee's department code number into the cash register. 3. Use the cash registers to take 20% off the price. Then push the sales tax button. Notice, use the cash register to take 20% off the price. The implication here is the employee can't be trusted to figure the 20% reduction for himself, so the cash register has to do it. You can begin to see why this is a level 3. If you required the employee to do it, it would be a higher level. 4, write your initials on the sales receipt. In other words, take responsibility for the sale. Implications, if anything's wrong, we know where to go. Find out why it's wrong. And finally, sell clothes to employees during store hours only. That's how to sell clothes to employees. Now, here's how to accept clothing returns from employees. Employees receive a store credit certificate for clothes they return to the store. Notice, they don't get cash back. They get a credit. 2, store credit certificates are next to the gift certificates. 3, employees may not get a cash refund for clothes they return to the store. You are a cashier. According to the notice shown, which I just read, What should you write on a store employee's receipt? And then it gives you 5 choices. In other words, it's asking you for specific information given in the written text. This is a level 3 because the sentences are simple and direct. Most put the subject first and the verb second. In other words, they're not complicated, highfalutin language. Tells you exactly what you need to know. There are short paragraphs and short sentences. There are direct instructions for simple tasks. The vocabulary includes common everyday words. Individuals have to pick out a clearly stated detail. They do not need to draw any conclusions. In other words, this is straightforward. What you need to do is in that text. You need to be able to extract it and then perform. That's what makes it a level 3. When you get to level 7, however, you get to a very long paragraph, which I won't read, about confidentiality between clients and consultants. And it goes into a lot of detail on what happens, what the responsibilities of client to consultant and consultant to a client are in order to be able to work together. And then there are a lot of also addendum or additional provisions about agreements and understandings made between employers and consultants, employees and consultants, and all the rest of it. And then it says, this agreement shall not become binding on either party until both parties execute it. In other words, both parties have to sign and agree to the terms of the confidentiality. If you've ever bought something online and you look, or you've looked to upgrade or download a new piece of software, and you look at the agreement that you have to sign with the company, nobody reads those, the copyright and all that, the requirements. But it says when you click yes that you've read it and understand it, but the fact of the matter is few of us do. Then it asks you specific information questions from that particular passage. And these questions are much more specific, much more detailed and complex and difficult than the straight instructions from before. So why would this be a level 7 item? The sentences are longer, more complex, denser. The document uses complex writing style. The paragraphs and sentences are filled with details and information. You got to be able to separate the important information from the unimportant information. Less common meanings of words are used. Individuals must imply the principles behind complicated instructions to new situations. You've got to be able to apply the principles to new situations as they come up. This is the example. I think what we've shown, and I'm going to kind of wind it up here because it looks like we've got 1 minute to go in our program. Obviously, what we've seen here is that many of the skills that we're looking for today are skills that you can't fix in the training room. They require a level of abstraction and sophistication in the education of the particular person that they come to the workplace with. They have to come to the employer with these kinds of abilities in order to be able to be trained. So therefore, what we're measuring now is not what they can do and how well they can do it, but whether, in fact, they have the talent and the abilities and the skills to be able to address the complexities of the modern workplace. That's what we're dealing with. I think the new capitalism of Richard Sennett is forcing us to go at a level, to a degree, that we were never able to go ourselves until now. I think this is incredibly exciting. This is our final program this week. We will not be with you tomorrow or Wednesday. The next time we will see you here live at the Virtual Center will be a week from today, next Monday. This is Bill O'Brien. Thank you so much for listening. Have a wonderful, wonderful week, Thank you, and I look forward to being with you again. Thank you.